Wow, do we have a lot to get into in this video here today, guys. And I'm talking about a lot. I got so much to show you. I'm going to show you some information in this video that is going to absolutely shock you. You're going to be like, you got to be flipping my flapjacks. This is really going on, okay? I was out there buying some stocks today. I bought 5 stocks in particular, including one stock that I bought 10,000 shares of here today. I'll share what those stocks are, share my perspective on what's going on in the market, what's the next move, and all those sorts of things. I appreciate you guys joining me as always. Now, to get started here, a little comedy at the start here, okay? So I was preparing this video. I had CNBC on the background, and all of a sudden I'm hearing somebody keeps talking about McDonald's back there, and I'm like, wait, what's going on back here? They're flipping flapjack and pitching McDonald's stock on CNBC. Like, holy smokers, you know how bad the market has to be for, these Wall Streeters to go on there and pitch McDonald's stock? We're talking about the bull case for McDonald's? Come on, man. Like, what? We don't need any bull case for McDonald's. It's freaking McDonald's. Like, come on. Like, oh boy. So yeah, if there was ever a moment in the market that shows you how far we have fallen, folks, it's McDonald's. And yeah, usually you don't hear that stock pitched too often unless you're in some, let's just call it a rough spot, a very rough spot, okay? Alrighty, guys, so starting out here at the top, NASDAQ down under 12,000. It closed under 12,000, which is a big number for the NASDAQ, but even a more important number is that S&P 500. It closed under 4,000 today. So, from the folks obviously look at these things on a short-term basis. Let's call them the short-term bulls. The 4,000 numbers are kind of let's just call it a stake in the sand to hold that level, and we're under 4,000 now at this point. And so the bears, I would say the short-term bears, that is, and well, there's no such thing as a long-term bear. There's no such thing as being bearish for the next 10 years. But the short-term bears are definitely feeling good that we're back under that 4,000 range, and now they're hoping that we go back down to 3,600, 3,700, something like that for S&P 500. So definitely some big levels dropped here today, and yeah, just kind of a rough one out there in general. The NASDAQ as of right now is down about 25% roughly year to date, which is a horrific, and I mean an absolutely horrific year for the NASDAQ. It very rarely goes down that much. Like, geez, very rare you see that sort of move. And here's the deal, okay? We were down at the lows about 35%, roughly 34, 35%. So, that's still quite a ways down there if we were to approach that range again. That just shows you how much the stock market has come back since that time. But yeah, we're down about 25% as of right now. S&P 500 is down almost 17% year to date, which, if you don't know, basically the S&P 500, your expected return usually on average is about 8% roughly a year, okay? And so, to see the stock market not only not up, let's say, approaching 8%, but down over double that amount is, it just shows you how bad the market really has been this year. Yeah, we're down about 17% on S&P as of right now. E-com continues to get shredded. Anything e-commerce related, no one wants any piece of any of these stocks right now. So Chewy reported numbers after the bell. What Chewy said essentially is revenues, basically revenues missed, EPS beat. But with that being said, the stock's selling off about 8.5% after hours. If you don't know Chewy, they're basically, an e-commerce company that sells like pet supplies and pet items and things like that, okay? So if you have dogs or cats or whatever, you might have used or at least considered using Chewy before. But yeah, I mean, this is a stock that it's still, it's a little ways away from that 52-week low of 22.22, which, man, if it hits back down those numbers, you guys know I love those twos. I might even have to personally buy the stock if it goes back down there. But, no one wants a piece of anything e-commerce related right now. Basically, what happened here is everybody was kind of forced to be home, and all these e-commerce companies put up these incredible numbers. I don't care if you're talking about the Chewy's or the Shopify's or the Amazon or whoever. You sold items online, your business was thriving, right? And then when you went from that to the world opening back up and people starting to go back more to physical stores, simultaneously, you're coming off these ridiculous comps, so your numbers aren't going to look as impressive. Simultaneously, everybody's getting hit with inflation, which obviously hurts the middle class immensely, who aren't maybe as likely to spend more money. Simultaneously, you also have a situation where the stimulus money's not out there, right? So, yeah, it's a very ugly situation, obviously, for all e-commerce related. bit. Now, these companies, are great buys, likely for the long term. Chewy, I don't know too well specifically. I'm going to have to do more research into this one. I've only done a very small amount of research. But when it comes to a lot of these e-commerce companies, they're tremendous opportunities over the long term. Shopify is a stock that's now 77% year to date. It has been absolutely devastated. And it falls in that e-commerce category that just no one wants a piece of right now for the reasons I just listed before there, okay? And Amazon, here's the deal with Amazon stock. This stock's down, getting close to 25% year to date, okay? And by the way, it's come back a lot. It was down 30+% at the lows. If Amazon did not have Amazon Web Services, AWS, I would almost guarantee you that this stock would be down 50% plus this year. The thing that is saving Amazon's stock price right now is Amazon Web Services. Literally, if all they had was their e-commerce side of the business that is, everybody knows, you probably shop on Amazon, I shop on Amazon, we all shop on Amazon, right? If that was the only business they had, I would almost guarantee that stock would be down 50% plus right now. But because that Amazon Web Services is saving the whole show right now, basically they get to only be down like 24, 25% right now. So that just, it goes to show you how impactful, another business can be to help your company and ultimately your stock price if you have something that's going on, right? And so that's even why I look at stocks like, let's say a Palantir, for instance. I've definitely heard some folks say, when it comes to Palantir, they want them to split the government business away from the commercial business. I don't think it's a good move. There's going to be some times when the government business is doing tremendous and the commercial business isn't doing good. There could be vice versa situation, right? Where the commercial business is doing great, but the government contracts are taking forever to come in. So I look at it as, if you've got successful businesses, put those successful businesses together because those can help immensely, especially in bad times. And there will be time periods when both businesses are clicking and they're doing amazing. And there's going to be some times when one business is faltering, kind of like Amazon's e-commerce numbers are not impressive right now, but Amazon Web Services is a consistent profit cash flow machine, and that is saving that stock and that's saving that stock price, okay? Now, this is exciting, okay? It's not all bad news, I can tell you that. Oil and gas stocks tanking today. Tanking. And, I opened up this and it was just Red Dead Redemption on my oil and gas stocks list here. And I love this, okay? And so when I saw that right away, I knew it was likely a rough day out there for commodities, which is something we need in a major way. And sure enough, it is. WTI down about 5% here today. Oats, for all my Oatly shareholders out there, this is great to see, man. Oats, I hope that price continues to collapse. We're still at elevated ranges, not compared to where we were at, 6 months ago, 12 months ago, 18 months ago. But, if you look at a 5-year average, oats are still very up there. We need that thing to continue to drop. That's going to help Oatly's margins and profitability in a major way. The commodities index in general down 3% plus here today. Wheat down 2.5%. Lumber down again 2% plus there. And with how rough housing could potentially get, I wouldn't be surprised if we see lumber price continue to go down. Natural gas down about 2%, but natural gas is still trading ridiculously rich right now. Long term, that is not sustainable. I can tell you that. It is the situation. I got something crazy to show you guys in just a moment, but that's not sustainable for the long term. I can tell you that much. Copper, good old copper, down about 2% here today. With usually how people look at copper is if you see the price of copper going down, the economy is likely either in recession or going into recession. Gold and corn down as well there. Look at this, okay? You can't make this stuff up. Come on, man. Seriously, this is really going on. China is aggressively reselling Russian gas to Europe, and Europe is pretending it has no idea what's going on, okay? This is absolutely just an epic kind of crazy situation going on there because obviously, I'm sure you guys might be aware, but Europe has a bunch of sanctions on Russia because of obviously, them going into Ukraine. We all know that, right? And so here we are in this situation where somehow that gas is still likely getting back to Europe. It's just going through a middleman. So isn't this just a situation, right? Maybe China gets to make a little, let's call it middleman money on this now. And, you go through these situations and it's just like, everything has a cause and effect, right? And you want to make a decision like that. Is it really going to help you? Is it really going to help your people? These are questions you got to ask yourself at some point in time, right? And I think those are fair questions to ask. All those sanctions, who's really getting hurt by that? Is Russia really getting hurt by that, or is it more along the lines of European citizens that are getting hurt by that, right? Just things to think about, to consider. A lot of people make these decisions and that are in power, and sometimes you start going through it, and like when it first happens, people are like excited, like, yeah, we win, and then as time goes on, it's like, wait, are we really winning, or are we actually hurting ourselves in this situation, right? And I think that's a fair question to ask, right? This was reported out there like crazy over the weekend. A lot of publications obviously brought this up. Russia's burning $10 million worth of natural gas every day near its border with Finland. Now, who knows, where else Russia could be potentially burning natural gas. But what a waste. I mean, think about that for a moment. Just what a waste that, natural gas prices are insanely expensive. This is something that is hurting in a massive way citizens across the world because natural gas prices are so expensive right now. And right now we're in summer. Imagine when we go into winter, the need for natural gas is going to be way higher, way higher. So here we are in this moment in time where you just look at it and it's like, think about all the people that are having to, suffer from this essentially, right? And I was watching Mav last night, and Mav brought up a great point, and he was pointing out like how many people die from essentially freezing to death, right? And with how high energy prices are, people are trying to do anything like chop wood in Europe, like in Germany and whatnot, and he was bringing out points about essentially, coal and just like, it's a mess, man. It is an absolute mess, and everybody's being hurt by the situation. And meanwhile, these natural resources that are needed are just being burned. Literally just burned. So, $10 million worth a day just for this one? Who's to say, Russia's not burning a bunch of more natural gas? Because it's not like you can just like shut it off and like, let's shut our natural gas off. When it's flowing, man, you just have to start burning it. Who knows? Maybe there's 20 million, 50 million, $100 million worth of natural gas being burned every day in Russia. We don't know. And that's just sad. It's just sad because the people are of these other countries that are paying these ridiculous prices for natural gas. And if that keeps up in the wintertime, it's going to be an ugly situation, man. And, but yeah, you got to sometimes just look at these things and be like, who's really being helped in all this, okay? Now, back to the market. So, just depressing subjects to speak about there. But back to the market here. So, a lot of folks are kind of wondering, or at least what I'm thinking actually personally, is I'm not really thinking about the whole NASDAQ down to 50%, number, right? In order to get NASDAQ down 50% plus, we're going to need a lot more devastation out there. We're going to need unemployment at like 10% and just a mess, okay? What I'm kind of looking at and kind of thinking here in regards to the market is that we could have a similar situation to an 08-09 in respect of, if you watch what happened in 08-09, we got a bottom in the fall time of 2008 essentially, okay? Then the market started to come back, did its thing a little bit, and then we, had the market fall back down again. Now, S&P 500 in that March hit a new low, but the NASDAQ 100 did not, okay? It hit a higher low. So I do kind of consider that being a possibility that we could be on some sort of same trajectory there. And if you think about it, right, the market bottom in June, maybe we get a second bottom in November, December, something like that, right? And by that time, I think a lot of people are going to be thinking the Fed's either done raising rates or is going to start potentially lowering rates, but at least kind of done. I think the inflation numbers are going to continue to kind of just come down and down and down, which is going to give the Fed more room to start giving the interpretation of like, hey, we're going to keep rates the same, we're going to stop raising, or we're going to potentially start cutting. Right now, the Fed just doesn't have that. They don't have that in the bag, and that's why people jumped the gun there and thought because inflation numbers went down 1 month, like the Fed was going to somehow like change their stance. No, of course that's not going to happen. The Fed needs to see 3 months, 4 months in a row of inflation numbers coming down and down and down. They need to continue to see PPI come down and CPI come down month after month for 3 or 4 months. At that point, the Fed can start changing their commentary, and you could start getting a situation where the Fed starts to mention things like, we're thinking about, and they won't mention them in this terms, but it'll be along those vibes when you read through the tea tree leaves, essentially. But it'll be like, hey, we're kind of planning on essentially, pausing raising interest rates or potentially cutting rates if the economy gets into a worse position and we see unemployment start to rise in any substantial way. And so that will obviously put the market in a let's just call it a good moment in time. The market it's hard to get the market in a good feeling right now because we have earnings that are subpar at best. On top of that, you have a Fed that's still going to raise rates. They're going to raise rates 2 more times this year. There's no doubt about that, okay? It's just a question of like how much do they raise each time? That's the big question. Is it 50 basis points or is it 100 basis points? Is it 75 basis points? Is it 25 basis points? That's the whole debate. And so we're in a kind of weird time in the market and kind of still a scary time in the market because of the Fed, right? And because of weak earnings right now that people are looking at. And by the way, Snapchat just announced, here recently that they're going to, from what I saw, they're going to cut about 20% of their staff, which goes into the whole, recession talk, right? And to potentially unemployment going up and those sorts of things. So that is just something to keep in mind there. So when it comes to like the NASDAQ, if we're going to look at this, we bottomed on the NASDAQ back in June. It was like 10.5, 10.6, somewhere around there. So it's definitely possible we could go back down there to those sorts of ranges or just a little higher. Let's just put it that way. But once again, if we're going to talk about a 50% plus crash in NASDAQ, we need earnings for every single company to tank. And specifically, you need big dogs. You need Apple, Google, Amazon, and Microsoft. You need all their earnings to tank in a massive way simultaneously with unemployment going to 7, 8, 9, 10%. If you can get that, then we're talking, then you can get NASDAQ down 50% plus, but you're not going to get that without that sort of situation happening. It's just, a pretty unrealistic situation. You can get the NASDAQ back down to 11,000, 10.7, 10.5, something like that, 10.8 on just fear. Right, and inflation's still high, and worries about the economy and worries about earnings and things like that. You can get the market back down there on that, but to get that 50% plus, you need a complete devastation out there. Let's just put it that way. I was buying some stocks here today. I bought some Schaff. I bought some Palantir today. I bought some Meta today. I bought some Avant today, 10,000 shares, but it's a small dollar amount. Let's just put it that way. And I bought some Honest here today, so 5 stocks. My plan in regards to deploying money into the market is, especially in September, if this market continues to fall, like basically I'll get more aggressive the more the market falls. So, let's say the NASDAQ was down, let's say the NASDAQ was down 5% today. I probably would have put, $15,000 into the account and invested today rather than $7,000. So that's just kind of the way I'm looking at it is the more heavy these stocks fall, the more heavy the market falls, if that continues to happen. And there's a big debate if that's going to happen, right? But if that continues to happen, I will invest more aggressively. And that's kind of the way I treat the market. Like the more things fall, the cheaper things get, the scarier it is, the more the VIX goes up, things like that, the more I'm like, okay, I want to invest aggressively, right? Now, in regards to investors in the market, and I'm talking to not just myself, but I'm talking to everybody out there. There's 2 issues with buying in a crash scenario like we have this year, okay? The first issue most people have the problem with, and then we'll get to the second issue, which I think is more direct to a lot of folks watching this video right now, okay? But the first issue people have with buying in a crash is they look out and they say, it's so scary. And that's the hard part, is to buy in a crash because it is so scary and you have so much going on that's bad and you have so much fear. There's never been a big, there's never been a NASDAQ that's gone down 25%, 30%, 40%, whatever, okay? It's never been a situation like that where it wasn't a scary time to be a buyer out there, okay? And so in every single one of these situations, you got to understand you are buying because you are optimistic in that things are going to be better in the future than they are today, okay? And every single one of these, there was a lot to be scared of. In that December 2018 crash, there was a lot to be scared of, right? In the Rona crash, there was so much to be scared of. In this crash, there's so much to be scared of. In 08, 09, there was so much to be scared of. In the tech bubble crash, there was so much to be scared of. So you got to understand, when it comes to these situations, it's going to look bad. And you're going to have to buy blindly. And it is what it is. It's part of the process. And people that were buying in 2009 were buying because they were optimistic and they were buying blind. There was nothing you had in 2009 to be super excited. If you were buying stocks in February, if you were buying stocks at any point in 2009, you had nothing until the very end because earnings started to come back. you had nothing to be excited about, man. If you were buying in late 2008 when the market was just tanking through the floor, you were buying blind. You were buying on optimism of the long term. Same thing here. Same thing in the double dip recession fears. All these situations, you were buying because you were optimistic about the long term. You thought there was going to be a brighter day ahead for the markets and for companies, okay? And so that's just very important. Now, the second issue, I think this is actually a bigger issue, because for a lot of you guys, you understand that you're buying because you're optimistic on these companies long term, right? And so it's not as much for your mind to wrap your head around buying in a crash, and yeah, it's scary, and yeah, it's so much bad news and things like that. But you understand that game. The hardest thing for folks that have already gone through that process and they are buying is to look out at the market and see so many stocks at such discounts, right? And to see stocks down 25, 35, 45, 55, 65, 75%, right? And to try to figure out where the best place to put your money in. And that's, in my opinion, the hardest thing to do in a crash, is trying to figure out where's the most bang for my buck, because there's a ton of discounts everywhere. I've only got a certain amount of money to deploy, and let's say each month, at the end of each month, let's say you have $1,000 more in income than you do expenses, which is kind of a similar amount that I had when I was working at Quick Trip back in the day. I usually had anywhere from like $1,000, maybe $2,000 a month extra in income versus my expenses. I've, since basically 08, 09, I've always kept my expenses lower than my income. So I've always, basically almost my entire life, other than the year and a half I took off and just kind of retired for a year and a half, I've always had more income than expenses. And if you're in that position, then you're always ready to buy, right? But you're looking out there at the market and you're like, oh my gosh, there's so many good deals. And that's where it really comes down to focusing on your 5 to 10 favorite stocks and making sure you dollar cost average into those. And try your best not to get distracted, because there's going to be so many other stocks that are heavy dips. There's probably 100 stocks. There's probably more than 100 stocks right now in the market that I think are good values right now, and I think are going to be big money makers over the next, let's just call it 3 to 5 years. With that being said, I'm not going to go out there and buy 150 stocks right now, or 125 stocks, or 100 stocks, or something like that, right? I really need to funnel my money into the stocks I believe in the most for the risk-reward standpoint over the next 5 years. And that's what you got to try to hone in on and focus on. And it's a very, very difficult thing, because you're going to see so many deals all over the place, man. Go back to June, go back to mid-June. I mean, Amazon was down 35%. All these stocks were just down massively. You had the growth names down 70, 80%, and a lot of them are still down that much. And it's just like, where do you put your money? And a lot of it comes down to who you believe in, like what businesses you understand the best, and what you feel comfortable deploying your money into. Some people feel only comfortable putting their money in big tech. Respect. Then you can just buy, Google and Amazon and all the big techs, right? Fair play, and Meta and all the others, right? Some people feel more comfortable investing in some of the growth companies. And the way I always think about it is, if you can get into revenue companies that grow their revenue more than what the economy is growing and inflation, if you add both those numbers together, and they can do that over a 5-10 year span, as a general rule, you're usually going to do very well in those companies. So let's say the economy, the GDP plus inflation is at let's say 5% on average a year. If you can get a company that's growing revenue 10% plus a year on average, and especially if you can get it for a pretty cheap valuation, you're likely going to end up in a pretty good situation. Now, if the company can't ever figure out how to get profitable or more profitable, things like that, that could be a whole issue. But as a general rule, if you can find companies that have much higher revenue growth than inflation plus GDP, you're usually going to be in a moneymaker stock over the coming years. That's what I've seen pretty continuously in the market. It's not a 100% foolproof plan, but it works, let's just call it pretty darn well, okay? So I hope you enjoyed that little, let's call it gem out there as always. I appreciate you guys joining me. Also, just so you know, we got a absolutely epic, massive flash sale coming up on the Become a Master of Stock Market course. If you want that deal shot to your inbox, that's my #1 course ever. If you want that deal shot to your inbox as soon as it drops on Labor Day, go ahead, check out pinned comment down there, and you'll get access to, all these videos when that deal drops, essentially. I mean, it's an epic course, man. I mean, these videos are one of a kind, let's just put it that way. So if you want to take advantage of that, check out pinned comment down there, enter in your email or number, and we'll send it over as soon as that flash sale drops. Much love as always, and have a great day.